Hey everybody, welcome to this kickoff to the 2022 market action. This is the free edition of our Trader Use Group Weekly Roundup for the trading week ending Jan 7, 2022. I'm Preston Brent. Thanks for tuning in. Well, you can see the theme here. Let the reindeer games begin. As we kick off 2022, we got a lot of cross currents going on in the market right now. And to top it off, we get earnings kicking off next week with three of the horsemen. On the financial side on Friday, that would be JP Morgan, Wells Fargo, and Citi. We got others too, but earnings are going to officially kick off for Q4. For our members, we're going to have an extra long session this tomorrow night, just kind of review where the markets are looking, how they're shaping up, and some of the allocation and rotation I'm seeing from some of the tech to more cyclical and probably value oriented, some of the growth coming down. But for this weekly edition here, hopefully everybody had a great holiday season as we kick off this year. So without further ado, why don't we kind of take a look at last week, which I guess you could probably say was the first trading week of the year. Okay. So if we look at it, we'll take a look at the index performance. You can see not a really good start to the year. Everybody was in the red. Obviously, the weekly and the year-to-date numbers are the same. Everybody's in the red. You can see the PE ratio, the forward PE ratio, still elevated at 21.25. I believe we're going to see repricing of that in the first half of this year. Treasury yields, you can see, jumped a good deal this past week. It's higher than the dividend yield in the S&P by almost 0.5%. The Treasury coming in at 1.771. The dividend yield for the S&P at 1.29. So we're starting to see a little bit of a divergence there. The earnings yield in the S&P still at 4.4%. Right, that's about a little over 2.5% higher than the 10-year Treasury. And then the current VIX, it was up on the week 8.94% to close out the week at 18.76. You can see the best performer for the week was a continuation of last year. Energy is the best, and it's also to kick off this year. The best performer for the week at a whopping 10.5% or so. Okay, energy is going to be one of the ones that I'm going to highly encourage folks to jump into this year. Okay, healthcare, one of the worst for the week, also same year to date, but I do believe healthcare is going to stage a pretty good little rally. More on that for our members as we get into our weekly market watch tomorrow evening. And if we look at this, and let's just take a look at the economic data that came out this week. As I said, it was a rather choppy week. Longer term bond yields increased a pretty good little bit. Higher interest rates kind of took a toll on growth stocks and tech heavy Nasdaq. Sentiment really turned horribly wrong on Wednesday following the Fed's mid-December policy meeting notes. Normally you don't see that big of a move, but we had some surprises in there. Obviously they discussed faster and more aggressive rate hikes. All right, so that was not as much of a surprise, but one of the bigger surprises was when they discussed steps to reduce the balance sheet. Okay, after raising the rates. That really put the markets in a little bit of a conundrum. Remember, the Fed balance sheet is slightly under 9 trillion, about 8.8 trillion right now. So they're going to look at taking that down. Economic data, we also saw the ISM manufacturing and the service sector still above expansionary, which is 50, but coming in just a little bit. And then the kicker at the end of the week, we saw monthly payrolls, job numbers. Employers added only 199,000 jobs. That was a big, big miss. I think they're expecting over 400,000. Really ugly. Although we did see unemployment fall to 3.9%, but the big number was 199,000 jobs. Really not a good number. Now, notice that didn't really drive interest rates lower and bonds higher for the week. It was not enough. So we're going to see bonds continuing to come down, interest rates continuing to go up. And of course, speaking of interest rates, and we're looking at U.S. Treasuries, they moved really higher for the week. The 10-year actually touched 1.8% this past week, which was the highest that we've seen since really the onset of the pandemic a year or so ago. Really moving on up there. So investors are pretty much digesting this more hawkish tone from the Feds from their meeting notes. And we did see spreads between investment grade corporate bonds and US Treasuries drift just a little bit wider on that. Okay, so remember, what we like to do is follow the credit spreads, and we like to look at the yield curve. These are things that can give us early warning as to what the markets are going to do, what the equity markets are going to do, and how they're going to react to economic data. Whether you trade it or not, you need to understand it. Members will spend more time on it, obviously, tomorrow evening in our weekly market watch. Okay. Now, if we go over the pond to Europe, you can see Europe, and let's just look at the index here. You're going to see, surprisingly, in the Europe, Euro stocks, FTSE, CAC 40, DAX, all in the green weekly, and of course, year-to-date numbers are the same, all finished in the green for the week. Now, that's primarily because Europe is just kind of bouncing back from a horrible year last year. The U.S. kind of led the way in the market activity all over. Don't expect those returns in 2022 and 2023. Okay. We did see inflation rise year over year in Europe 5%. That was an acceleration from 4.9% this past November. We're getting European countries reacting very negatively to the Omicron virus. So it's hitting their service sector, business sector. Their PMI data fell just a little bit, still above 50, but coming in a little bit. So we're going to see how that plays out. And then, of course, over in the Asian markets, if we look at them, you can see the Nikkei was in the red for the week and for the year. They've got the Japanese markets were kind of concerned about the Fed policy here in the U.S., the aggressive monetary policy tightening, and some of the change in the tenor and the tone in the Fed meeting notes. So that kind of hit them just a little bit. Although we are seeing Japan's manufacturing services sector still above 50, so that is an expansionary mode, but a lot of a slowdown, right? And then, of course, if we come over, well, let me just move this back here. If we come over and we look at the other part of the Asian markets, China and the Hang Seng, over in China, you can see they were in the red as well. Their PMI data basically rose just a little bit, but they're just barely in expansionary mode, coming in at 50.9. Remember, they were at 49.9 in November, which was contraction. So they're kind of steady as she goes, but really not knocking the ball out of the park. Same thing with Japan. So we're just kind of getting that muddling through. The other thing China's trying to wrestle with as well is their property markets, their real estate markets. A lot of their big property developers still are hurting for cash, and it's causing a big liquidity squeeze in the housing markets, high debt levels. So that's going to continue to show weakness. But as I told our members, I don't expect a lot of that to contagion spread to Europe or the US for the reasons that I've outlined to you guys before. Okay. So that's a little bit about what I'm seeing. Then, of course, just take a step out for just 1 second. You can see the S&P performance since 1920 and the decade performance, decade by decade, and the number of bear markets for every 10-year period that makes up that decade. Okay. So you can see for the 20s, that includes 2020, 2021. We've had one bear market, that would be COVID. You can see the return thus far from January 1st, 2020 to where we are now. The decade average is 103% with about 2.3 bear markets per decade. The annual average is a little over 10%, with a bear market about every 5 years, all right, 21%, all right, 0.21 as an average. There's been a total of 26 bear markets. I suspect this year, as I will review with our members, we're going to have a 10 to a 15% pullback in the first half of this year. Trying to predict it is a fool's errand, but we got key numbers that we're going to watch, credit spreads and things like that, to see, just where we're going to go. I think the second half of the year we're going to grind higher, and then we're going to really get uglier in 23 going into 24. Okay. Now we may go into a bear market this year. We could have a policy misstep by the Feds. It all depends on how this thing shakes itself out. What I want to do is shift you over to the daily charts. the key charts rather. And let's take a look first at the S&P 500 E-mini futures. Okay, we'll take a look at that first, and then we'll swing into the others. I'll wait for it to print on the screen there. So as you can see, right now, I've got the E-mini S&P 500 futures. You can see the 2021 closing price. We're clearly in the red. We're also resting nicely on the 50 EMA. These are short, medium, and longer term support points. You can see I've got a little bit of a shaded zone down there that represents a little bit of a support zone. I'll probably widen it just a little bit, but we haven't really gotten off naturally to a strong start. Typically, when the markets have a strong finish in December, they have a strong kickoff in January. But I said typically, not all the time. And I think the Fed meeting notes set the tenor here for the markets. And just to show you guys, I'm going to show you this is a FANG index, a customized index that I recalibrated over this weekend to show you. And this FANG index includes Microsoft, Facebook, Apple, Netflix, Google, and Amazon. You can see the last all-time high on this index was on November 19th of last year. You can see the 2021 close and where we are now. We're down near the lows of 2022. Granted, we just kicked things off, but money's coming out of the tech sector. Now, keep in mind, these guys represent about 23 to 25% of the overall index of the S&P. So where these guys go, they're going to create an awful amount of drag on the rest of the index or the S&P. Now, if we look at Nasdaq, right, that is just the Nasdaq 100 futures. You can see here we're well below the 50 EMA. I can see us going much lower. We're going to grind lower as market allocation starts to take effect. We're near the 20, that should say 2022. Let me just update that because I know I'll forget that, right? It's always something, right? So let me just update that. Put it in there. So we're near the 2022 closing price or the low price. So technology is really not faring that very well, right? And let's look at the Russell. This is even uglier. If we look at the Russell futures, look at this. We're closing at the lows. We're below the 50 EMA. We're below the 200 EMA. We're still in this overall wide zone that, quite frankly, we've been in really going all the way back here to 2021, right? If I were just, let me just jump out a second and go to a weekly so it doesn't look so convoluted. And let's just open it up just a little bit. You can see in this weekly chart, this is a price to nowhere. We haven't gone anywhere. We're almost at the lower end here. So now the key question is, are we going to stay in this range or and move back up, or are we going to bust a move out of this range? If we bust a move out of this range, we're going a lot lower, guys. And the rest of the index is going to come down as well. So we got to watch this very, very carefully here on this index. And then, of course, if we go over here to Bitcoin, Bitcoin, I think, may have a little bit more ways to go. You can see we're near the 2022 low price. We're in the red year to date. You can see the November 10th all-time highs for Bitcoin was about 69,000 and some change. But this is just ugly, ugly, ugly. This also shows that Bitcoin is not acting as the kind of hedge that some people thought it would. We've blown through both the 50 and the 200. This keeps up, we're going to get a cross, what they call a death cross between the 50 and the 200. So all in all, not looking good right now. I do believe 2022 Bitcoin is slowly going to work its way back up, but for now, the near term, they're just flushing out some of the traders in this thing. Okay, and if we come over here and look at volatility, the one thing that I saw that was very interesting with vol, notice even though we've been moving lower in the equity markets, so is volatility. After we hit a high point here of around 2106, we closed out the week at 1876. So these past few days, volatility's been moving lower while price has been moving lower. Now, when that happens, that basically means the markets are not that concerned right now, and it's more of just a common allocation, or let me rephrase that, a reallocation, a lot out of tech and growth into other types of sectors. Members, we'll review that tomorrow evening, but this is something that you're going to have to look at on your portfolios and start to accommodate, because I can promise you interest rates are going to be going higher. Now, if we get a big enough, sharp enough sell-off, you will see interest rates start to dip a little bit. And bonds move a little bit higher. But longer term, you want to be neutral to short bonds and neutral to long interest rates. Okay, and there are ways that we can trade this. Again, members, we'll spend a little bit of extra time this tomorrow evening reviewing that. And speaking of bonds, let's look at the bond market. It was down 22 ticks on Friday. You can see we took out the prior pivot low in bonds that was made a little bit. Let me just get this thing up here like this so I can see the chart. So this prior pivot low was made back here in November, but we've taken that out. You can see here's the COVID low right here in bonds, and we're almost down to that at 153.07. One ugly day, and we've taken out the COVID lows. So bonds, again, are below the opening price for the year. The high price was just an afterthought. So you can see the 50 is already below the 200. So we're setting up for another year or two of longer term going lower in bonds. And members, I'll review a number of different ways to play this, but this is where you want to be in 2022, right? Now, understand, if we do get a 10 to 15% pullback, we could get a rise higher in bonds and a momentary dip in interest rates, but that would only be a buying opportunity for rates or a selling opportunity for bond markets. Okay, so just think of it that way. Of course, if we look at the dollar, it had an ugly day on Friday. And you can see we're still in the green, just barely. We're above the 2021 close for the US dollar. We're near the highs that were made last year, right up here. But the dollar, I believe, is going to underperform the euro for the year. All right. This may be a good time at the beginning of the year. Generally, when you get into a new calendar year, currencies tend to trend for the first 90 days or so. So I could see the dollar trending sideways to slightly down. And if we look at the euro, because it really underperformed last year, ugly. And now you can see we're off the bottom here. And you can see this looks like an extended Elliott wave pattern of a 3, 4, and then a possibly 5. So I was calling for the euro to actually move just a little bit lower. It's still in the red for the year before really altering its stance. It just depends right now. There's some ifs on how long they leave the economy and businesses closed down across Europe, because those idiots just gone batshit crazy with masks and shutdowns for this flu-like symptoms of the Omicron. So we'll see what they do. But if they keep it shut down more, it could weaken the euro, but that'll just give us a better chance to look at longs from that perspective, right? Get a better price for a long. And of course, if we look at gold, gold is just kind of been on a nowhere train. You can see gold is until it moves up into the green for the year, psychologically, I think gold is just going to be in no man's land near term. Okay. I think as we get through earnings, remember, we got a Fed meeting coming up here in January, I think on the 26th. Then we skip February and then we go into March. So this meeting coming up is going to be a big one for currencies, bonds, and precious metals. So we're going to watch this very closely. Okay. And of course, if we come down here to energy, it really had a really good week. Not good on Friday, but it had a good week. You can see where it's moving to. We're solid in the green for the year to date. You can see the 2022 low, 21 close. So it's moving up. I do believe longer term, oil is going to move back up into the mid to upper 80s. We'll probably challenge this level right here, this kind of a resistance zone, right? We'll probably challenge that level, find some resistance there, maybe bounce off of it a little bit before we move higher. If that can provide support, we'll run up into the upper 80s. It's not going to do much for inflation. It's probably going to make inflation a little bit worse, but that's a little bit of where I see the energy market going. Nat gas, if we have a very cold winter, it can move it up, but otherwise, I had said fade this move and fade this move. Any move over the 50 EMA, you want to be fading nat gas. It should not be this expensive, right? Just should not be. All right, guys, that's kind of an abbreviated view of where we are right now. Members, we're going to have a great fun session tomorrow evening on some of the sector rotation and some bets that we want to start looking at placing for the 2022 year. Otherwise, everybody, welcome back to the markets. I had a nice week off, just enjoying really probably more food than I should have had, but it was a fun time. I will see members tomorrow evening. For our free viewers on our blog, I will see you next weekend. If you're not a member, I highly encourage you to come in. We got some great trades coming up that are going to be a lot of fun and I believe very profitable. Take care, everybody. Ciao.